Good morning from Newport Beach, California. It's a pleasure to open this workshop on shadow banking, a topic that's near and dear to my heart, and I thank Cornell for inviting me. Since I coined shadow banking back in August of 2007, the term has taken on many different definitions, and I'm quite sure in your proceedings today you'll be debating precisely the definition of shadow banking, because you'll be talking about how the regulatory structure should be changed in order to prevent another Minsky moment that happens when you have a shadow banking system run amok. From my perspective, the best definition of shadow banking is an entity that is engaged in maturity, credit, and liquidity transformation, old-fashioned banking activity, maturity, credit, and liquidity transformation without a backstop against a run. In many respects, the whole Minsky moment of 2007 and 2008 was about a run on the shadow banking system. The shadow banking system had promised its liability holders something that it could not deliver. That is known as a run, and we know what happened in the aftermath. And in many respects, what happened at that time was textbook, was absolute textbook. The conventional banking system, until we created deposit insurance and a lender of last resort, was prone to runs, known as panics in history, because inherently the banking system is promising something that collectively it cannot deliver, which is known as liquidity at par. You look at old-fashioned banks, you think in terms of bank deposits, like you write your checks on, they're always at par. Banks take liabilities that have the promise of always at par, and by definition transform them into something that doesn't trade at par in real time. That's called maturity transformation, longer maturities than tomorrow morning. Credit transformation, meaning loans to those who don't necessarily have the ability to pay back tomorrow, and liquidity transformation as well, from the standpoint of securities that don't necessarily meet the needs of the depositors. So that's the essence of old-fashioned banking. As Professor Gordon from Yale has written beautifully, essentially what the shadow banking system did was to convince the public that it was just as good as the conventional banking system, that its liabilities could always trade at par. And as a practical matter, that was impossible, that your conventional banking system can only make its liabilities trade at par because of deposit insurance and, even more importantly, a lender of last resort. We know that we dealt with the Minsky moment, the panic, the run of 2007 and 2008 by essentially extending the safety nets of the public to the shadow banking system. We did that explicitly for money market mutual funds with insurance underwritten by the Treasury. And also after that, we saw the Fed step up essentially and make a number of facilities available to the shadow banking system. And also we had the FDIC allow financial institutions broadly defined to issue securities, not just deposits, using FDIC insurance. So essentially we had to socialize in 2007 and 2008 the inherent risk of the banking system, proving yet again that banking is inherently a joint venture between the private sector and the public sector. That's all in the way of history, and I think the history has been written about by a number of authors very well. I think what you're focusing in on is the path forward, and I start with the very simple proposition that banking is inherently a private-public venture. So to pretend that we can have a system like we had prior to 2007 and 8 just simply doesn't make sense. that as a joint venture, you want to have the creativity, the market forces that come from the private sector, but also you want to have the protection against runs that come with the public sector. So the regulatory conundrum that we're all trying to solve is how to get the best of both. Essentially to have the invisible hand of the marketplace do its magic in allocating resources through a banking system broadly defined, at the same time to have the visible fist, if you will, of government to make those liabilities in a extremist situation trade at par. So it's a mixing of the invisible hand and the visible fist, and trying to find that balance right is difficult, but I think that's the balance that we are searching for. And actually, I'm pretty optimistic that we will prevent another type of event of 2007 and 2008. It will not be a risk-free proposition. I think we'll probably have less creativity in the banking system, but maybe that's not a bad sort of thing. And I guess just in conclusion, the fact that bankers so loudly complain these days about Dodd-Frank, to me, is a blessing because it means it's working, that they push back from the government against unbridled capitalism in banking has been successful because the capitalists are complaining. So actually, I'm quite optimistic that the system is protected against a rerun of what happened in 07 and 08. And I think it's an evolutionary phenomena. I don't think you can ever set regulation forever for the simple reason creative bankers will figure an arbitrage around it. So you can't get perfection in regulation. I think it would be silly to even think about that. But we should never let the pursuit of perfection be the enemy of the good. And I commend you for having your conference today and trying to find out and explore, thinking out loud together, what the good constitutes. I wish you a great day.